Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, guys, there's a ton of downside risk in the market right now. I know it seems like things are honky dory, but they're not. We're going to show you exactly why. Got some charts for you. Let's dive in.
Trade Genius.
Hey guys, we got Black Friday specials. They're really cool. We have the best pricing for the year. You can get our basic package, our advanced packages, our VIP rooms, software, trade options, trade crypto, trade the futures. With us, get our indicators, best prices of the year. Take advantage of it. Thanks for listening.
Okay, Bob. So, right now the market seems very complacent. We're up here. We had a big run up. There's no pullback, it seems. Everybody, I've heard multiple times that this market doesn't pull back anymore. That being said, right now there's quite a bit of downside risk. What say you?
Yeah, the old phrase, come in with the street lights come on and nothing good happens after midnight.
Yeah.
Well, nothing good happens in the stock market when the tail risk indexes fall to near zero. And we're at a point now where there's so much put selling right now, Phil, that is overwhelming the protection that people normally would get, the signal that they would get. And it's creating an environment where, when I was in the Marine Corps, you threw a hand grenade, but you knew when you pulled the pin how much time you had before the grenade would actually explode. Here, you're pulling the pin and it could go at 1 second or 10 seconds. And I think we're going to find that people are going to get their hands blown off here really soon, because these vents, when the vol flips, these overnight events, we can wake up to a 100-day down market, and then people will try to buy that dip. And then from there, it will start cascading. And what I'm told is that if we get a 1 to 1.5% down move, there's so much put selling right now, people clamoring for near-term sold puts for income that they have to cover fast, and they're not making enough money. So the reward to risk ratio is out of balance, and these people are on a hair trigger, and the computer guys will close out in a heartbeat and just going to blow the put prices higher and get a bigger sell. And here's the chart that shows that. This is showing you net protection and tail risk protection. They're two different things. Tail risk is looking at big out of the money stuff, Phil. Nobody's protecting themselves out of money. Nobody cares. It's like we're living for today. They just don't care. And then the put protection near term is gone because we have so many people zero DTEing or 1 DTEing these puts sold just to capture that near term cash, and don't know what the event is. Don't know when there's enough tide pushed out that it's going to come in. I don't know what the catalyst is going to be, but we're at a point now where it just makes absolutely no sense to not protect what you already own. And I think smart money is going to start doing that. And I think it's kind of covered up right now. I think the smart money's always been protecting themselves, but the fast money is overwhelming what we see in the index. And I think people are going to be shocked when this thing flips. I mean, we had vol hit today, Phil, the VIX, 4-year low in the VIX. I mean, that's even below the complacency before the COVID crisis. Right. So we're just at a point of stupidity right now.
Yeah, and what's concerning too is that the levels of the skew that we were getting here relative to where we've been in the past. And if you look on the chart there from basically after September 2022, you saw we had a very sharp fall off in the demand for downside protection. We're lower than that in terms of the nation skew dex. So, it tells you that people are more complacent. Now, what happened in Q4 is the market had a sharp sell-off, which ultimately put in the low for our bear market. So it's funny because this market can be stuck in a bearish condition and people just don't care. We're getting into a very bipolar market where it's like it's either risk on or risk off, and these moves are very one way. They're one way down, they're one way back up, more so one way back up. But they're very sharp, and we're getting like this thrashing back and forth. It's like a herd of wildebeest, and they go from one alligator-infested pond to another trying to get a drink. And that's the best way I could describe it right now. It's just all on one side 1 week and all on the other side the other week.
Yeah, and we see it in the data too. And what's really funny is that since the 16th of November, like small caps have gone nowhere, yep. Literally zero. All the action's been in the basically the FANG dead stocks. That's it. it. Everything else is just dying. I mean, we were joking in the room. I said these last 10 days, my wife loves me because every time she asks for help, I can leave the trading desk because I'm not missing anything at all.
Yeah.
And I mean, it's just so boring. We're running out of things to talk about. And that's when it gets dangerous. Because this happened before. When we even had a longer run one summer, that I think that's when Powell did his August surprise, or one of them did that August surprise, whatever, at Jackson Hole. But for those 28 trading days before, it was so boring. And we were call selling. So we thought we were geniuses, just writing credit spreads, not just calls, but on the put side. And then one day you wake up and basically all the profit you made in the 28 days got wiped out in 2 because you had 2 big loss days, wiped out the last 6 weeks of trading. Right. And I think we're going to come up with that again. I think we're going to have a 2 or 3 day trading event, that's basically going to wipe out the last 6 to 10 weeks of this market move. And it's going to be breathtaking.
Yeah. And unless there's a systemic event tied to that, if it's just strictly a market break situation where it's technical and some of the hedges unwound, I actually think you would buy that and trade that back up into the middle of January or so. And that's only because of the hedging flows. And that would be contingent on the fact that you probably don't want to see 4,300 break. But if Bob's right, then you actually would trade down that low quickly. And then that would be the end of that. And then right back up. And it would continue with this bipolar action of, straight down and straight back up. Then after that, though, then when you get past January, that's where the rubber meets the road, because now we're going to start dealing with, okay, is this market really rolling over? Is the job data going to continue to deteriorate? The Fed's not going to budge on the rates at any time soon unless something catastrophic happens. And Yellen's run out of ammo in terms of T-bills. And we've been talking about the debt issuance hitting in Q4. Honestly, guys, we haven't even seen that hit yet. We only had a few auctions so far. The meat of all that starts now, starts this week. So we are due for liquidity coming out of the system. So knowing that we're ripe for a pullback, and knowing that this pullback could go a little farther than maybe people think it could, you just want to be prepared for that in the coming days. But again, we think it's probably a buying opportunity into potentially an end of year move, based on the fact that it doesn't go too far down. But it's a situation where we have to wait and see, because if it does break 4,300, then Bob, I think we could actually accelerate quite a bit lower.
Yeah, and look, we're not making a market call here because I just have no idea. I mean, it's literally, today's market, Monday's market there was just no buyers, but nobody sold anything either. So when you have this passive environment with passive flows of managed money, it's going to take some sort of event to drive these passive managers. They're going to have to be driven by some active managers with enough volume here. So we did see some weird things on Friday with the VIX. We got a reversal today on the VIX. Those things start the ball rolling. But yeah, and for us, we see deterioration technically everywhere except for momentum. And we've learned through bitter experience that unless that price follows it, all you're doing is throwing money away. So we don't have to FOMO this. You can catch this move 1 or 2 days late, I think, and make a lot of money. Yep. And that's what we're doing. The bulls are still in charge until the bears show that they can sustain more than 1 or 2 days of this move. And we're going to learn a lot this week, Phil. If we're not down decently by Friday with all the bond issuances, then this market has just too much coming out of the woodwork for this thing to sell off until after the new year.
Well, here's something you guys can take with you. We broke over a swing high that we put in, I think it was September 1st. We put a swing high in SPX at 45.55-ish, give or take a few points. You guys can see it on the chart. Watch that level. We've kind of bounced on it today, but watch if we start breaking below that. And the reason why that's important is a lot of people will be breakout trading over that level. And since we've gotten up there, we've already cleaned out any stops that were up there that were short, which gives liquidity to the market makers, and they can roll this thing back down. Because remember, market makers like to play ups and downs, and that's where a lot of the bigger money is made, taking out stops and then reversing. So watch that level, because if we got breakout traders that were trying to buy this thinking that we broke higher and we're going to continue to push up, we can actually trap a bunch of people there, get our 2, 3, 4 day pullback that could be somewhat violent, and then get a bounce. So that's, to me, 45.55, that area, that previous swing high. If we start trading below that this week, and also keep in mind, we got GDP numbers coming out, I believe, on Wednesday, and then core PCE, which the Fed really hones in on, is on Thursday. So those are 2 important numbers we don't want to skip over. And I think if we have any excuse for weakness off of those numbers, if GDP contracts, and I have no idea what the number is going to be, but if it did, that could be a catalyst for some further downside pressure.
Yeah, I think the employment report is the first. I don't know if it's going to be this Friday or next next Friday. But for this Friday, we're jam packed with a lot of data.
Yeah, so we'll be covering that come Wednesday and Thursday, and we'll let you guys know what we think. So anyway, let us know what you guys think of this market. You think it's too complacent? You think we got downside risks? We'd love to hear from you. Otherwise, check out our specials. We still have specials running. If you did not catch the Black Friday, we've got specials still running. We're maintaining those deep discounts. So check it out over at tradegenius.co. I'd love to see you guys in the room with us, and we'll see you guys on the next video. Take care.
Trade Genius.